Hey everybody, welcome back to another edition of 5 Question Friday, where I take 5 questions primarily from our live Q&A show we do every other Monday night. Questions in the chat that I didn't get to. I also will throw in some questions I get via email, and I do my best to answer them, on Friday. Thus, 5 Question Friday. I've got 5 great questions for you today, so let's dive right in. Question number 1. Am I crazy to be paying a 2% fee to manage my investments at Morgan Stanley? Yes, you are. All right, question number 2. All right, well, maybe I can give some context to that question before I move on to question number 2. I can think of 2 reasons to pay someone else to manage my investments. One would be they're brilliant investors and they can beat the market. So, for example, if Warren Buffett called me up, notwithstanding his age, and he said, "Hey, Rob, do you want me to manage some money for you?" I would probably say yes. But short of that, that's one way. Now, the reality is the vast majority of people in the world can't beat the market on a consistent basis. And for those that do for even a short period of time, what happens? Capital floods into those funds because everyone's excited to beat the market. And then the manager has a problem. They've got billions of dollars of capital to manage, and now it becomes even harder for them to beat the market. And of course, eventually they don't. But that would be, in theory, one reason to pay a big fee if you thought they could beat the market. That certainly, in my view, doesn't apply to even the most elite firms on Wall Street, including, I'm sorry to say, Morgan Stanley. I would not bet on Morgan Stanley beating the market. But that would be just one reason. A second reason might be, look, I don't really want to beat the market. I don't want to manage it. I don't want to have to think about rebalancing. I just want someone else to do it. That's fine. That's perfectly reasonable reason to hire someone to help you, but fees really matter, right? You might pay someone 2% if they can beat the market consistently, even on an after fee basis, right? But now it's just managing a portfolio because you don't want to. Now I want to keep my fees absolutely as low as possible, and 2% is, in my view, extremely high. I think the real key is for you to understand how it's going to affect your wealth over time. One tool, it's a free tool, but you certainly don't have to use it, but it's Empower. And I'm looking at their fee analyzer now. This is just a demo account with, as you can see, a balance of, I just put together a simple index fund portfolio of about $1 million. You get to this screen through planning and then retirement fee analyzer. And if you link your accounts, Empower pulls in the expense ratios of your funds. For this particular demo, I linked index funds, so you can see the expense ratio for all, a weighted average. It's only 4 basis points, right? But what you can do is this will calculate your fees until you retire. So in this plan, I've got the person, they're age 55 and they're going to retire at 65. So this is just showing us the effective fees over a 10-year period. And with just index funds, that's not too bad. On $1 million, paying $7,700 in fees over the course of 10 years, and that's after we factor in contributions and employer matches and annual growth. But here's where we can put in this 2% Morgan Stanley fee. So let's get it, I'll get it as close to 2%. Oh, there we go. Well, the fee kind of jumps up from $7,000 to $368,000, and that's assuming Morgan Stanley puts you in these low-cost index funds. If they put you in even more expensive mutual funds and ETFs and other types of investments, the cost of the fees could go up even higher. So in my view, 2% fee is just not justified. I can't think of, frankly, anyone, I guess, other than Warren Buffett, maybe, but anyone I'd pay 2% to manage my investments. That's my take anyway. Maybe you disagree, but great question. All right, question number 2. A viewer named Kathy wanted me to analyze bond portfolio. She said, look, I've got BND, and we'll take a look at that if you're not familiar with that ticker. But she was wondering, what about 50% in BND and the other 50% in a TIPS fund? And she gave us an example, VIPSX. She wanted to kind of know, how should we think through that? Well, I think it's a great question. Let me show you the funds first. We'll just use Morningstar. So this is BND, a very well-known Vanguard total bond fund. I own shares of this fund. It just tracks a Bloomberg aggregate U.S. bond index. So that's the first fund. We can see it's very inexpensive, just 3 basis points. Its most recent yield is about 4.5%. And then VIPSX, also a Vanguard fund, and it's very inexpensive, but a bit more. Adjusted expense ratio is 0.2. And it's, let's see, its trailing 12-month is just over 4%. This is a mutual fund, and this is an ETF. You can tell by the tickers. And I only point that out because on Morningstar, it presents the data a little differently between ETFs and mutual funds. Not a big deal, but that's why the screens are a bit different. So when you're comparing bond funds, first thing we want to know is the effective duration. In other words, what's the average time of the bonds that these funds hold before you're gonna get your money back through interest payments and maturity of the bonds. Of course, they're constantly buying and selling bonds in the portfolio, and these particularly the B&D is going to have over 10,000 different bonds. We can look at that, but we want to know the duration. In this case, they're both about the same. We go to portfolio, and we'll see the duration here is just under 6. This one's a tad longer. It's 6.7. We can also look at the portfolio here. I think it'll show us, yeah. So a little bit longer, which means that this fund, VIPSX, has slightly more interest rate risk, meaning it might lose a little bit more money in the short term if interest rates rise, might make a little bit more money if interest rates go down, but they're both would be considered intermediate term bond funds. So that's fine. So we're comparing, in that sense, we're comparing comparable funds. The big difference is in the type of bonds that they invest in. So B&D basically invests in 3 kinds of bonds. About half the fund is in U.S. government treasuries, U.S. government bonds. About a quarter of it's in corporate bonds. This would be investment grade corporate bonds. Think, bonds issued by a Microsoft or an Apple. And then 20, we'll call it 20, I guess 22%. They also have some cash is in securitized bonds. I believe this is primarily, agency bonds of the federal government backed by mortgages primarily. And so a fairly diversified portfolio of bonds. It doesn't include what some would call high yield or junk bonds. It also doesn't include, for the most part, any international bonds. But that's B&D. And this TIPS fund, it's all U.S. government bonds, but specifically Treasury inflation protected securities. And so the primary difference in understanding that is you could think of TIPS as taking a regular old U.S. government bond, but they're going to add an insurance policy to it. They're going to say, hey, if inflation goes up, we'll adjust the principal of your bond by the rate of inflation, so you're protected. That's going to cost you some money, though. Insurance isn't free. How do you pay for it? Well, by accepting a lower coupon rate or a lower interest rate. So there's sort of a trade-off, and then that raises the question, all right, well, will that insurance that I pay for through lower yields, if you will, lower coupon rate, will that pay off? Will I actually be glad I did that because I'll get more money? Well, the answer depends. And it depends on whether inflation ends up being higher than the market thought it would be at the time you invested in that fund. And there's actually a delta between the two of those yields that you can track that shows you the difference. And but of course, for me, the answer is I have no idea. I don't know which one will be better. And so I personally like to invest in both. I sort of hedge my bet. And we could do that. We could do, as the viewer mentioned in their question, 50-50. What would that look like? Well, I put this in Portfolio Visualizer. Now this goes back 10 years from 2015 to December of just a month ago. And we can see in this period of time, VIPSX outperformed by a bit. It had a compound annual growth rate of just over 2%. I know the numbers are small, but trust me, that's what it says. The B&D was lower, 1.3, as it turned out. And what I like to do is roughly 50-50. So for me, it would have been about 1.67. Now you look at this and you say, well, why not just put it all in VIPSX? It outperformed. Well, it did for the last 10 years. I don't personally have any reason to believe that it will consistently outperform. I think it's largely going to depend on what inflation does compared to what the market thinks inflation is going to do. And that gets me back to why I personally prefer splitting the difference 50-50. And that's just my approach. I suppose if you stuck with whatever decision you make for the long term and you just picked, let's say B&D, for example, which is a common fund used in what's known as the 3 fund portfolio, I think that's certainly a reasonable choice. My choice over the last few years has been 50-50. That's my approach. And there you go. That's how I think through that, at a very quick and high level perspective. All right, third question. The viewer says, in Boldin, which used to be called New Retirement, it's a retirement planning software, what are you setting the projected returns? Now, this is an important question, and it applies for any financial planning software, not just Boldin. You could use Projection Lab, you could use Prelana, you may have a financial advisor, and they're putting this number in for you for whatever tool they use. But let me show you what it looks like in Boldin. So this is again, a demo account. And I'm at the accounts and assets, and we can drill down into we'll just pick one of them, doesn't matter which one. We'll pick traditional IRA. And you can see here, I have to select the optimistic rate of return and the pessimistic rate of return. And then when I'm evaluating my plan, I can tell Boldin, hey, use the optimistic return, or use the pessimistic return, or just use an average. You actually do that up here. Right here, optimistic, average, and pessimistic. So I can look at my plan through either of those three lenses and see how it affects my plan. But all that raises the question that the viewer asked, well, what should I put in here? And a couple of thoughts there. First of all, one thing to keep in mind, let's imagine we knew ahead of time that over our retirement, say a 30-year retirement, our investments, whatever they were, stocks, bonds, whatever our allocation was going to return at 8% on average. So we could go back in here if we know ahead of time. Of course we don't, but let's just imagine. We could say, well, we're just going to put 8% in both of them. So that'll make average 8% as well, because we know that's what it's going to be. Would that, and if it turned out that that was true, that over the 30 years of our retirement, our compound annual growth rate was 8%, does that sort of guarantee us that our plan was accurate? And that's how life will look based on our plan now over the next 30 years. Unfortunately, the answer is no. And why is that? Well, because we know that stocks and bonds don't return the same thing every year. They may average, in this case, 8%, but some years stocks are going to be up. Some years they're going to be down by a lot. It may average 8% over a 30-year period, but it's not going to be smooth like that. And it turns out when we're modeling retirement, the first 10 years of a 30-year retirement are particularly important. They call it sequence of returns risk. Let's imagine we average 8%, but the first 10 years are ugly, and we lose a lot of money in the stock market. It can get so bad in theory that we would run out of money before we could enjoy the good years that maybe occur in years 10 to 20 or 20 to 30. In fact, one article and I'll link to all of this below the video, but one article that sort of makes this point is a recent article on Kitz's website right here. Published just last month. How much does having the right capital market assumptions, which is just a fancy way of saying, your returns assumptions, matter in retirement planning? And that's the point that this article makes, is that because of sequence of returns risk, even if we could assume our assumptions are correct, that doesn't mean the outcomes we'll experience will match that. Now, don't despair. It's one of the reasons, if we go back, let me actually go back to Boldin. Here it is. It's one of the reasons that we can run Monte Carlo simulations with retirement planning software like Boldin, so that it varies the returns. And we see that if we go to the overview page, this bottom dark line is actually the result of running Monte Carlo simulations and looking at the sort of the bottom 10% result. This top line is assuming the same rate of return every single year. So we can model all that variability in tools like Boldin through Monte Carlo simulations, but it still gets us back to, all right, Rob, that's fine, but you still haven't told me, what do I put in these optimistic, I didn't save the 8%, so it doesn't matter. What do I put in these optimistic and pessimistic rates of return? My approach is to do this. For each account, whatever my asset allocation is for that account, and in my case it varies. I have different asset allocations in, say, a Roth account versus taxable versus traditional. But whatever it is, say it's 70-30 or 80-20 or whatever it might be, is I'll look at the historical returns that kind of allocation has generated over the last, say, 50 years. And you can do that through tools like Portfolio Visualizer. Vanguard has an article on it. I'll leave links below the video. And what I tend to do is set whatever that average is as my optimistic. And then, so let's go back to here as an example. Let's say it's 9%. I'll put 9% as optimistic. I tend to roughly cut it in half for pessimistic. In this case, you could do 4.5. I might just do 5. And that's going to give me an average of 7. Now you say, well, Rob, I appreciate that. And there's some basis for that, I suppose. Optimistic, you're setting at what the historical average has been. But the 5% cutting it in half, it sounds like you're kind of, I don't know, guessing. Well, in some ways, I am. But what it's allowing me to do is then model my plan based on averages, right? That's the 9% in our hypothetical. But then in returns that are significantly below average, almost half roughly below the average return. So I think I'm doing a pretty good job stress testing my plan with those assumptions. Will it work out for me? I'll tell you in 30 years, but that's my approach. I think it's reasonable. If you take a different approach to setting those return assumptions in whatever retirement planning software you use, I'd love to hear about it. Leave a comment below this video. All right, question number 4. So someone wrote in and said they've got a federal pension and Social Security, and that covers not only all of their sort of necessary expenses in retirement, but it also covers some foreign travel that they plan to take. And even after all that, they've still got $300,000 in the thrift savings plan and $200,000 in a traditional IRA. That's a good situation to have, huh? But they want to know, how do we invest that? Given that effectively that we don't need it to fund our retirement, what in the world should I do with it? Good problem to have. The answer for me is always the same, really, when I'm dealing with this kind of question in just about any circumstance. Question 1 for me is, when will you spend the money? Not when you have to spend it. That might answer your question. I got to spend it in 7 years. But maybe you don't have to spend it, but you think you'll choose to spend it. When is that? Because that's really, for me, going to drive the asset allocation. If you say, well, I don't think I'm ever going to spend it, and I'm going to leave it to charity when I pass away or family members, and at least based on the best I can tell, I mean, anything can happen in our lives, but you're 65 and healthy, it could be decades. So in that case, if you don't need it, I would personally tend for a higher allocation to stocks. Exactly what that would be, in part depends on personal preference. Is it 80-20, 90-10? I generally shy away from 100% stocks, but that's how I would think about it. When am I going to need it? And then when I do need it, if I ever do, am I going to need it all at once? Am I going to need it over a few short years? Am I going to need it over 30 years like retirement planning? That's going to affect how I invest it as well. I'm going to invest 529 money differently because, I might not need it for 18 years until my child or grandchild goes to college. But once I start needing it, I'm going to need it all within just a few years. And so I'm going to think about that differently than, say, retirement, where I start spending at 65, but I'm going to stretch my spending, hopefully, over 30 years or more. So I won't have to get nearly as conservative with my retirement portfolio as I would with a 529 plan, where once I start using it, I'm going to be using 25% of it a year. So I would be thinking about those things. And then finally, I would also be thinking about, what if things, some bad things really happen in the market and that balance gets cut in half by 50% or more? How's that going to affect my life? Now, based on the viewer's question, it doesn't sound like it's going to affect their life really at all. And so that's a good position to be in. But if that's not your position, that's sort of the third question I ask. If this gets cut by 50% or more, where does that leave me and how much time do I have to recover? So that's how I think through those issues. All right, the fifth and final question came from a viewer about direct indexing. They sold a business, they've got some money, they don't need it for 10 to 20 years. And their advisor said, hey, rather than just putting it in index funds, let us use direct indexing. That's where they'll invest in the individual companies or some number of them that are in an index. Sometimes it can be 100 or more companies, but the idea is, as some of those companies, their prices go down, they can sell those companies within the fund or within their managed account and buy similar companies. Got to avoid the wash sale rule, but then they can take advantage of tax loss harvesting. And they even claim, potentially, that the tax advantages could pay for their fees. And the viewer wanted to know, what do I think about it? Well, I've talked about direct indexing in the past. You can find those videos in the channel. By and large, I don't think it's worth it, and I'll tell you why. There's basically two reasons. The first is, I think in most cases, the tax benefits of direct indexing start to fade over time, because as you've held these investments for longer and longer periods of time, you're going to see fewer and fewer of them at actual losses, at least hopefully, right? And so eventually, as time passes, you're just not going to have a lot of tax loss harvesting options. And in fact, there's one article, here it is, that actually reached that conclusion. I will link to this below the video, but I will show you, here's the actual study. And I read this years ago, but the real takeaway for me was right here. For investors with only long-term capital gains from other sources, the tax benefit is reduced to zero after approximately 5 years since inception. Now, there can be exceptions. You're continuing to contribute significant amounts of capital every year. That could maybe cause the tax loss harvesting benefits to go past, in this case, 5 years. Or you regularly have short-term capital gains that you're trying to offset. So there could be some exceptions, but generally, I think the benefits start to fade. And then what does that leave you with? Well, it leaves you with a portfolio of what could be hundreds of different companies in a taxable account. You're paying the fee for this account that's never going to go away. And if you ever want to manage all of this on your own, you're stuck managing what could be hundreds of positions. I just don't think the complexity is generally worth it. At least that's my take. So there you go. Appreciate you listening to another edition of 5 Question Friday. If you have any questions, leave them in the comments below. Be happy to help you out any way I can. And until next time, remember, the best thing money can buy is financial freedom.